Hello, this is Andrew Thake from Minds and Money. Delighted to have with me today Shayne McGuire from the Teachers Retirement System of Texas. Great to have you with us today, Shayne.
Great to be here. Thank you.
Great stuff. Perhaps I can kick off with a nice opening question. What were the key themes that drove the gold market in 2021?
Well, first off, as we know, gold spiked to $2,000 an ounce in the fall last year. And so partly it was just coming off that strong performance, and also the sense that we were getting out of the COVID crisis. So that was a main driver. Also, the fact that equities continued to do extremely well was a detractor from interest in gold. But I think there are two main drivers. The first is the dollar. I think, as many will recall, the expectation was that the dollar would continue weakening as it had done late last year, and that this would continue into this year to the benefit of emerging markets, commodities broadly speaking, and gold to some extent. But the opposite happened. In fact, today the dollar is clearly breaking out again, and it had been gathering steam earlier the year. And as many know, it's difficult for the gold to do well when the dollar is strong. But perhaps even more important than that is the tapering fear, meaning the reduction in Federal Reserve stimulus that's been widely anticipated, considering that inflation has been rising. And people remember what happened in 2013 when there was a taper tantrum, as it was called back then, when gold fell very, very sharply as interest rates rose. So those were the main themes, I believe.
Why hasn't gold performed that well on a relative basis since its all-time high of last year?
Well, once again, I'd say stocks, the dollar, but also in times like this, there's a sense that that stocks are TINA. There is no alternative, and gold just becomes simply forgotten. I mean, people just aren't even talking about it, meaning the major asset allocators, pension funds like the one I work for, endowments, et cetera, there's just no interest in gold right now. I think that's mainly what it is. It had that big move up, and it's just lagged.
Mm-hmm. How are gold mining companies currently priced? Are they cheap or expensively priced against the current spot price of gold?
Well, right now at a 5% discount rate, large producers are trading at about 1.4 times NAV, which is cheap, historically around 2 or higher. Barrick's at 1.5 times, looks cheap. Agnico is probably around 1.6, Newmont 1.8, and the medium producers are trading at around 0.7 to 1.2 times. Silver producers like Hecla are trading at 1.9 times earnings. So they look very cheap, but it's never really about the valuation. I'm exaggerating. I think at this point, it's not really about the valuation that people are focused on. It's simply sentiment about gold right now is a slightly bearish. So, you know, there's the valuation is less important to mainstream investors anyway. And as you know, just miners in general are just driven by gold sentiment, which is depressed right now.
Are we on the cusp of a shift in US monetary policy?
It's difficult to say. I think on the one hand, you have continuing bottlenecks in the global economy that are tremendous, and there is upward wage pressure in the United States. So these are pointing to the need for the Fed to tighten policy. And I think that's broadly expected, that the Fed will be doing so. But on the other hand, you have the city economic surprise indices that have been trending down all year, most notably in the United States, Europe, Japan, and emerging markets. The acronym used for the city economic surprise index is CESI. So China's CESI has actually stabilized after declining sharply. But I think most would agree that the economy is going to decelerate going forward. So should the Fed taper into this weakening backdrop? The market is waiting to see. So we'll see what's going to happen. So you have the fact that you have inflation on the one hand continuing, and yet growth is clearly decelerating. So that's an interesting quagmire for the Fed at this point.
Mm-hmm. And so you can think that that sort of like tapering of the QE sort of stimulus is actually like still on the table then.
Yeah, I think there's this widespread expectation that the Fed is going to be tightening, but like I said, they realize that the economy is starting to slow down. Obviously, economic growth is quite healthy, quite good in the United States in particular, but things are slowing down slightly.
If I recall that you have written a book about silver, what's your view on silver at the moment?
I have. Well, silver is simply high beta to gold, as most know. I think what's interesting is that many of the meme stocks that started to blast off early this year led many to believe that silver, because silver had been discussed broadly among the meme crowd, and it had that spike early in the year, that it would be joining them. But silver is always closely tied to gold for better or for worse. And even though it's used in many industrial applications and demand has been strong, on the investment side, the fact that gold has lagged has affected silver investment. So until there's a clear sign that gold is going to start doing well again, I think silver will remain just kind of depressed as it's been this year.
How easy is it as an investor to get exposure to silver? Because I guess one of the challenges out there is that there aren't too many, I guess, pure play silver companies. A lot of silver companies that you invest in are effectively silver and gold, or they're silver and zinc. Does that sort of present you sort of like problems as an investor?
Yes, it's a problem when people want to gain exposure, and I say people meaning institutional money, which really is what moves the markets to a large degree. When people want to gain exposure to silver, it's a little frustrating because there really isn't that much out there. There aren't that many listed stocks of any size. We know Wheaton, Silver Wheaton is now called Wheaton Precious Metals, right? Simply because they can't find enough exposure to silver. And ironically, as I wrote, there is less above ground silver than gold in dollar value. Obviously more ounces, but less actual silver in dollar terms than there is gold. So it is ironically slightly more scarce than gold in that regard.
What about the other white metals such as palladium, platinum, and rhodium?
So in this weak year for precious metals, the biggest surprise to me, at least, has been the collapse of palladium. So palladium eclipsed gold in dollar value per ounce in 2019, rising all the way to $3,000 an ounce this year, and has since plunged to below or right around $1,900. Platinum was in no man's land for a long time, below $1,000. Then it spiked to $1,300 and now is well below $1,000. So I have no view on either, but I've certainly been noticing the price action. And I don't have any view on rhodium, really.
Sure. Any sort of like reasons for the collapse of palladium?
Frankly, I'm just not sure. I think if you wanted to say there are fundamental reasons, why would it have spiked so high and come down so quickly? I think there's a lot of speculative interest in the metal. I mean, it's a small market that just a small number of players can make it move sharply. But frankly, I just haven't been watching it that closely. I mean, like I said, I certainly have noticed the charts.
Sure. You've obviously been through a number of mining cycles. Are we in a super cycle?
Yeah, it's difficult to say. I mean, obviously I look at the precious metals mining cycle, and I think that's what you're thinking about mostly. Mining overall, in turn adding the industrial metals, which are, much larger, et cetera. That's a harder call. But I think we'll be in a super cycle if it becomes clear that the Fed needs to loosen policy again, because we're at the zero lower bound on the Fed funds rate, where effectively the short-term rate is zero. So this is why many policy observers and economists have been urging the Fed to raise interest rates many months ago. And that's policy reload. You really need higher rates in part so that you can loosen when the economy slows down again. So if the Fed needs to loosen policy again, it's going to be starting from a point where rates are extremely low, or at zero, basically. So I think many people have criticized the Fed for being so slow to raise rates. So I think a super cycle would start if the Fed needs to loosen policy and needs to consider possibly going into some extreme ways of loosening, like going to negative rates or so. I don't think most people are thinking that that's possible, but if they need to loosen policy, they're going to have less options than in the past.
Sure. I guess that one thing that is a little bit different from this, what they call a super cycle and up cycle, is one thing that's a little bit different to the last one is, I guess, the emergence of themes such as decarbonisation, the green economy, and ESG. How do you factor ESG into your investments?
Well, I think most portfolio managers have been forced to think about ESG because it's becoming a formal part of the investment process for many fund managers. So even if you have no interest in it for whatever personal reasons, the reality is that, let's say, tobacco stocks are not doing well, and there's less and less interest in that type of investment. And mining, which is seen as a for some as a highly polluting industry, is one that's being forced to react. And it's encouraging to see that many mining companies, perhaps most, have taken ESG very seriously, because the investors, the custodians of capital, are certainly very interested in it, and they want to see progress for the mining industry. And we're starting to see it. It's becoming widespread, as you know, and I think it's a very positive thing.
Sure. Another sort of thing, trend we've seen, a fact we've seen over the last 18 months has been COVID-19, and I guess that's meant a lack of travel to sites. How has that sort of impacted you and your sort of job in investment? Because I'm assuming, I might be wrong here, but a lot of investments I'm guessing that you make, you've either got prior knowledge of the management team and have met them face to face, or you have done a site visit. But obviously those are two things that you've probably been restricted on being able to do in the last 18 months. Have you managed to cope with that?
Yes, I have. And most of the investments that we made have been with companies that we already know fairly well. We're familiar with the management. We visited sites. So I think most of the time, I mean, I guess it's been harder for new investment opportunities, but I don't think it's been anything all that significant that's really impeded our way of managing the fund.
Yeah. Do you think that the mining industry did well in terms of coping with COVID-19?
Yeah. From what I've seen, they've adapted quite well, out of necessity, right?
Yeah.
But yeah, I think they have done quite well in general.
Looking ahead to sort of I guess 2022 and beyond, what do you see as being the outlook for the mining industry? Are there any particular sort of key themes or trends that you can sort of expect to see becoming more prevalent?
Well, I think the main thing is how the metal's doing. Frankly, I just think that's what's going to be the major driver of change going forward. I mean, if we're I don't expect this. I'm an optimist, but if we're going to enter another period where gold price appreciation becomes more subdued, and perhaps we just kind of, once again go into a period of stagnation in the price, then management will be forced to adapt to that, and perhaps we'll start seeing hedging again. But I think over the next few years, it's going to continue to be a scramble for scarce assets and in the best jurisdictions. So that will continue to be the driving themes: quality management, quality of asset, right jurisdiction.
Yeah, and just in terms of that, as an investor, you mentioned obviously you look at the quality of the management team, the quality of the asset, and obviously the right jurisdiction. How do you decide which jurisdictions that you go and invest and which that you don't? Presumably you've got a checklist of criteria, and there's certain green lights that you're looking for. Maybe I'll spin it in a positive way. What are the green lights that you look for in investment jurisdiction?
Well, I think they're fairly well known. I mean, the reason it's been fairly simple to invest in, say, Canada, Australia, the United States, Mexico, the well-known jurisdictions of choice, is that there hasn't been a substantial discount, or there is a discount, but it's not tremendous, that would force asset managers to really think, okay, we really need to take a hard look at the South American asset because or African asset. I'm just speaking Africa in general. Obviously, there are many different countries. I realize that, but if the discount were substantial, I think that would force me and others to look at many of the assets in these jurisdictions more seriously. But the valuation gap just isn't huge yet. That's what would force us to look at other areas. But for the time being, you can find very properly valued or attractively valued assets in the main jurisdictions that I mentioned.
Okay. Well, look, I think we've reached our time there. So all that remains for me to do is thank you very much for your time. That was Shayne McGuire from the Teachers Retirement System of Texas. Thank you very much for your time, Shayne.
Thank you. It's been a pleasure.